This is Steve Piloff from George Mason University. Let's talk about relevant cash flows when we're evaluating a project. When we're evaluating a project, the reason we need relevant cash flows is because we want to compute the NPV. So if we're saying, should we accept or reject this project, we want to focus on NPV. It's the best of our measures. It is the one that works with any pattern of cash flows, and it always gives essentially the right answer because it's focused on value. In order to compute NPV, it's just the present value of all expected cash flows. So you need to have the expected cash flows, and it's the present value. So you need the cost of capital, which, if you remember, the cost of capital is you've got some project and it has a certain level of risk, and you find stocks and bonds with that same level of risk. The expected return on those stocks and bonds is what we use as our cost of capital. We think about it that if we're going to do this project and tie our cash up in this project, we're giving up the opportunity to do this other thing, so we want to take that into account. So when we're focusing on expected cash flows, when we're evaluating those for a particular project, what we're interested in is what we refer to as incremental cash flows. What are the cash flows to the firm that only occur because of the project? And the way we get that is by thinking what would be the expected cash flow for the entire firm if they did the project minus what would be the expected cash flow to the firm if they didn't do the project. So that's the incremental expected cash flow, is with minus without. So you can think about what the contribution is of doing the project by looking at the whole firm with minus the whole firm without. It's nice we can focus just on the incremental piece, and we don't necessarily have to do an entire analysis of the whole firm with and the entire analysis of the whole firm without. We can just look at what would this project influence on cash flows, and we do that by looking at revenues, expenses, and the various components. Marginal, incremental, and relevant, those are synonymous terms. That tells us that essentially what we want to look at. In each year, in a given year for a project, our relevant cash flows, the item that we want to discount to get NPV, has four components. The first is operating cash flow, and those are the cash flows that are produced from the project doing the business of the project. So if it's a Patriot Theaters expanding up into New England, then it's from the cash associated with selling tickets and paying ushers and selling popcorn and things like that. Second item, cash flow effects and the changes in net working capital. So operating cash flow, it's based on accounting, which recognizes revenues and expenses when sales are made. And so sometimes it misses things, and sometimes it counts things it shouldn't when we're focusing on cash flow. By looking at changes in net working capital, it helps us get that right. Third item is cash flow from capital spending. That's the money that's spent buying equipment, buying machinery, buying property, things like that, long-term capital assets associated with a project. And then along the way, sometimes we upgrade, sometimes a project's done and we're left with equipment that we sell. So the cash that we get from selling the equipment, that's associated and only there because of the project, we need to take into account. And the fourth item is something called terminal value, which is widely used in practice, which is the value of a project at a particular point in time that we can use in our analysis because it captures all the subsequent years. And so in any given year, add those four up, you get your relevant cash flows, you discount those, you get your NPV. And throughout a lot of the topics, the word expected is often omitted, but these are expected cash flows. We don't know exactly what's going to happen when the project unfolds, but we do our best, make our best guess, taking into account all the things that could happen, and that's what we base our analysis on. We're going to look at 1 year as our period for our project so that we can focus on relevant cash flow issues. First really important thing, we want to separate out two important decisions. One is the capital investment decision, the other is the financing decision. Where the money comes from is one decision, how the money is spent is another. And therefore, we want to separate those out. And the way that affects our analysis is we ignore any and all cash flows associated with debt and equity. So debt issuance proceeds means if we borrow money, the money we get. Debt payments are coupons, our interest. Equity issuance proceeds, if we sell stock and get money. If we pay dividends, if we buy back stock, that's us paying money to get stock. All of these really involve cash going in or out. We just ignore them. One way to think about it is we agree to do these. We agree to borrow, we agree to issue some stock. Okay, now we got one, so we're locked in. Now we got one last opportunity to decide if we're going to do this project or not. So in a sense, that financing decision's already been locked in. We really don't want this to be a project, oh, it's good if we borrow, but it's not good if we have to issue stock.